One of the last remaining resources for guaranteed income in retirement is Social Security. So it's important to understand how much of it's yours to keep and how much you may have to pay right back to Uncle Sam. Hi, I'm Jared with Carlin Financial Group. For the best retirement information to help make sure your money lasts as long as you do, be sure you subscribe to our channel and click that notification bell to be notified when we release new videos. Did you know that prior to 1983, Social Security benefits were exempt from taxation? That's right. Until just about 40 years ago, you could receive your Social Security and as much other income as you'd like and still got to take home the full amount of your benefit. Now, all of that changed in 1983, and now those benefits can be subject to income tax under certain circumstances. So, what circumstances? Well, let's dig in a little bit and find out more of what I'm talking about. While Social Security provides many Americans retirement income, for many retirees it's simply not enough to get by, and they must continue to work. For many others, who may in fact be fully retired, they could still have other sources of income outside of Social Security. Now, for those with additional income sources, you need to understand the concept of provisional income and how it's calculated. In other words, provisional or combined income, as it's sometimes called, is used to determine how much of your Social Security you might have to pay taxes on. Understanding that can be an important step in helping to mitigate and minimize some of your tax burden during retirement. So how do we calculate provisional income? Well, luckily, it's really rather simple. First, you need to know your adjusted gross income. Now, this will be your income from work, from capital gains, dividends, most qualified retirement account distributions, any pension payments you may receive. Pretty much any form of taxable income will count. Now, we start with the adjusted gross income, or AGI, from your tax return that excludes Social Security benefits. Next, we're going to add interest income that's not taxable at the federal level. Now, if you own municipal bonds, for example, municipal bond interest is exempt from federal taxation, so you would add that number. Finally, you want to add 1/2 of your Social Security benefit from your Form SAA 1099. And again, remember, if you're married, you want to include income from both spouses if you file jointly. Now, when this calculation's all complete, the result is what Social Security calls combined income, or as it's also referred to, your provisional income. So, for example, let's say that your gross income is $20,000 and you earn $2,000 in municipal bond interest. You're going to add those two amounts together to arrive at $22,000. Now let's assume that you also receive $24,000 in Social Security benefits. You want to divide that number in half and you get $12,000. When you add $22,000 plus the $12,000 from half of your Social Security, you find out that in this example, your provisional income would be $34,000. What other questions do you have about Social Security or taxation in retirement? Leave us a comment below and we'll do our best to address it in a future video. Now, how does provisional income affect taxation? Well, that depends on your income level. Similar to our progressive income tax system, there are cutoffs for provisional income that affect the taxation of your Social Security benefits at different levels of income. Currently, these threshold numbers are $25,000 and $34,000 for individuals, and $32,000 and $44,000 if you're married and filed jointly. Now, if you're an individual who has a combined or provisional income of less than $25,000, then none of your Social Security benefits will be subject to taxation. The same is true for married couples that make less than $34,000 in provisional income. Now, once you've passed these two cutoffs, the potential for tax exposure for your Social Security benefits is greatly increased. In fact, the respective tax burdens, or the amount of your Social Security that will be subject to taxation, are up to 50% for individuals who have provisional income above $25,000 but below $34,000, and for married filers, $32,000 to $44,000, and up to 85% for individuals who have provisional income above $34,000 and married couples with income above $44,000. Now, calculating your specific tax burden for Social Security income in any given year is a bit more involved and specific to your unique situation, so we'll include a link down below to the IRS website where you can get more specifics and they can help try and calculate that for you for this year. We may also delve a little more into those calculations in a future video. Social Security planning on its own can be quite complex and sometimes confusing. If you're looking to develop your plan but would like a little help, look down below in the description to find the link to apply to become our client. I hope this video was informative for you, and I thank you for sharing a bit of your day with me. Don't forget to subscribe to our channel so you won't miss out when we post those new videos, and share this video with a friend or family member that you think might benefit from it. And as always, remember, live today, plan for tomorrow.